I wanted to first start in this presentation talking about small business insurance and how it works. Insurance has been around forever. Insurance at its core is all about grouping and sharing risk. That looks like you paying someone a small amount of money each month in exchange for a promise that if something bad happens, that they will take care of you. Insurance protects you from financial risks associated with operating your business. Well, let's talk about rating and risk. Insurance companies organize and group customers together so that they can share risk amongst each other. They do this by analyzing how risky your business is and how likely you are to file a claim. The rate that you end up paying is a direct result of this calculation. There are multiple factors that make up this calculation, but it all boils down to one word: classification. Classification is made up of four basic questions that the insurance company is trying to answer. The first one is, what does your business do? Insurance companies will try and classify what type of business and what industry your business operates in. For example, if I'm a plumber, they need to know about whether I do residential plumbing, commercial plumbing. If I'm an accountant, they want to know if I do corporate accounting or, again, personal accounting. These things matter. They want to know who I am, what my business does, who my clients are, and really at the end of the day, who I'm working with. The next question is, how large is your business? So no two businesses are the same. If I'm a plumber that's a one-man operation and the guy down the road is a 10 to 15-man operation, our businesses are very different. I might be able to serve 5, 6, 7 clients a month, and his operation will be able to take care of dozens and dozens and dozens of customers a month, and his exposure therefore is a lot higher. So what that ends up looking like is that guy will get charged more than I will because he's servicing more clients and there's more opportunities for claims to be filed. The next question that they want to ask is, where does your business operate? Where is a little bit of a weird one, but there are different rates in different zip codes in different cities in different states in different parts of the world. So for example, I live here in Ohio, and the rate to be an insurance agent and have insurance in Ohio is much different than it would be in California, much different than it would be in Florida, New York, and all other states. Even within my own state, there's differences in the zip code. Insurance rates in Columbus are different than they are in Cincinnati, and so on and so forth. The reason for this is there's different claim experiences. You have different clientele. There's different population sizes. Businesses and buildings are closer together here than they are out in the country. So what it all boils down to is that the location that you live can have a higher claim rate, a lower claim rate, and just be a completely different area, even though you conduct the same type of business. Lastly, one of the questions that they ask in general is, how good are you at what they do? And they'll ask this question by saying multiple things. They'll say, how long have you been in business? How many claims have you had in the last 5 years? What were the amount of those claims? All of this is to gauge how risky you are to them. Because like we said earlier, no two businesses are the same. One guy could do a sloppy job at doing plumbing in someone's house, and another one could do a great job and have no claims on his record. And this one is going to get a much higher rate than that one would. It's pretty straightforward, but those are the four questions that make up classification. Once you have this classification and your business has been properly classified, they will assign you a rate based off this classification, and coupled with that will be the type of coverages that you select.